Hello, agents. Hello, everyone. So, what in the world is a walkaway annuity? I look through I can't find this term in any brochures or anything. So, what is a walkaway annuity anyway? What in the world is it? Let's talk about it. Let's see. What is a walkaway annuity? Walkaway fixed annuity. Look at this. I made this little sign because it's a walkaway sign. That's my walkaway sign. All right. So, let's look. There's repeating charges and walkaway surrender. So what does that mean? Well, deferred annuities have early withdrawal charges. These charges are there to protect the insurer from having to sell assets early at a possible loss, right? They're supposed to match duration assets. If you do a 3 year, it's supposed to have a 3-year asset, matching that to make your to make their money on the money to pay the client, right? So surrender charges which end after the initial guarantee period is over are known as walkaway annuities. They're affectionately known as walkaway annuities. Walkaway annuity is not an official term. It was created after the innovation of rolling or repeating surrender charges. So one of the insurance companies developed a new thing. It had a rolling surrender. So someone on the other marketing side said, hey, how can we counter this non-walkaway, this repeating surrender? Well, let's call ours a walkaway. And I think that's basically how the word walkaway started. In that sense, in that type of environment. Rolling and repeating surrender charges were created to offer greater rates. So as interest rates were dropping, the insurance companies were finding ways to maximize the way they can pay out interest rates and everything. So they thought of a rolling and repeating surrender charges because in theory, these monies would be stickier than liquid options. So if the annuity matured after 3 years and the client kept it another maybe 8 months and then could leave, well, that takes care of that 8-month leaving. You have only that 30-day window for people to leave at that point. So basically what it did, it traps the clients that aren't paying attention, delay, or miss a deadline. They're stuck. Usually these rates aren't as high as maybe new money rates. So that's the history behind the walkaway. So let's take a look. So a repeating surrender charge says, if you buy a 3-year annuity and the surrender charge is 987, you have a 30-day window after that 3rd year to exit. And if you don't, it repeats again, another 987 with another 30-day window, and so on and so forth, on and on and on. Whereas a walkaway annuity has a 987 surrender and a 0 thereafter, very clear 0. So you can stay in as long as you like. It'll have a guaranteed minimum rate, and then you are liquid. So it's in and out. You can do whatever you want there. So let's take a look at how they illustrate these two. So as you can see, the rate here was guaranteed for 3 years, and the surrender and annuity values never match off for this entire time because the surrender charge is always increasing. So after the 3rd year here, you're at 549 on your accumulation, but if you miss that 30-day window, you lose all the gain down to 516. And we're assuming both these annuities start with $500,000. So let's look at the non-recurring surrender charge, and you see all these columns match after the 3rd year, 551, 827, 551, 827. And even under the guaranteed values, or the existing values, you see these even match off, even though they're different because one's assumed and one's guaranteed. Obviously, the first 3 years all match off here. But as you get down the road, after the initial term, we have better liquidity in this product on the walkaway. You see they all match off durations. So how can one complement the other? So let's look at the large repeating charges. Oftentimes these will have a little bit better interest rate. So the clients may gravitate towards that. So let's say you open one with 50, 250, or $1 million, and you come up to one of your 30-day windows. Well, if you would have, with a small premium, purchased a walkaway at the same time, matching duration. So a 3-year walkaway with a 3-year recurring. And these you can start with, in some cases, as little as $250 a month or $5,000, very common, to get a flexible premium. That's another thing. You'll need a flexible premium walkaway in this situation to complement the large repeating charge product. So if you put, let's say, $1 million in the repeating, and after 3 years it's over, and you had opened an inexpensive non-repeating, you could take that repeating money in that window and drop it in to the non-repeating. So for very little, you can move all your money, and now all of a sudden you have options, right? And this really works better for qualified money because you can move in and out and there's no cost basis issue, but it can be done with non-qualified as well, using partial 1035 exchanges. And of course, there's more rules and restrictions and regulations regarding the non-qualified actually than qualified. But I think it's really great if you're going to buy one for like $5,000, open a flex premium product that has a minimum guarantee, say, of 1%. Then after the third year, your $1 million maybe grew to $1,090,000. And now you put that $1,090,000 into the flex premium with no charges now. So now you have it liquid and you can move that. If it's qualified, you can take 250, put it here, 250 there. It just really opens the world for options. So I think everyone should own a flexible premium, low initial premium, deferred annuity with a decent minimum guarantee. That way you have options if you do decide to jump into these 30-day window products, which most of them are now. By the way, if you need a deferred annuity quote, multi-year guarantee annuity quote, visit annuityexperts.com. Go ahead and highlight that MIGA rate. Go ahead and click on where it says deferred annuity illustrations. Pull up this form. You go ahead and fill that out. If it's done correctly, you filled in all the information. You hit submit. You'll get this wonderful little thank you page. So here's some disclosures. Pause the screen if you want to read. These are more for my sale presentations. And that's the end of this presentation. Hope you all enjoyed that. There we go. If you have any questions, give me a call, 800-373-9697. Be sure to visit all our Rumble, LinkedIn, and YouTube channels for the most up-to-date stuff. And again, really, agents, if you have questions more about this stuff, just give us a holler. We're here. We answer the phone, so you don't get press 1 or anything for a person. Hope you're all having a great week. Today is Wednesday. And that's it. Talk to you soon. Enjoy. Thank you. Bye-bye.